This year, we're pleased to have Andy Nasser, Chief Investment Officer of Scotia Wealth Management, and Noah Blackstein, Vice President and Senior Portfolio Manager with 1832 Asset Management, on our panel to share their thoughts. Andy is a CFA charter holder, is an award-winning portfolio manager with approaching 20 years experience in investment management and investment strategy. Andy joined Scotia Wealth Management's Global Portfolio Advisory Group in February of 2018 from a private investment firm. He brings a breadth of experience across fixed income, global and domestic equity, real estate, infrastructure, and healthcare, and has been featured as a recurring guest on BNN's Market Call. And here, who may need to do the heavy lifting tonight, is Noah Blackstein. He manages over $5 billion in U.S. and global growth portfolios for Dynamic. Alongside his mutual fund mandates, Noah manages two hedge funds, Dynamic Alpha Performance, which is a conservatively managed hedge fund designed to protect capital and wealth, and Dynamic Global Growth Opportunities Fund, which is managed with the goal of delivering superior long-term returns. Noah has a proven 25-plus year record of investment success and is the recipient of numerous industry awards. He has regularly appeared in many well-known publications, including Barron's, The Wall Street Journal, and has been a featured guest on CNBC and other respected financial news programs. So thank you, Noah, for being here, and hopefully Andy will be able to join us very shortly. We're privileged to have you here this evening, and thank you for making the time to join us and your willingness to share your thoughts and insights.
No, as we've discussed, markets have been pretty good to investors over the last couple of years, particularly in the United States. Sure. Where do you think we can go from here? Is there any fuel left?
I think so. I think, though, as we look into 2020, I think, I've been doing this for a long period of time. I joined Dynamic in 1997, and I've been running the same U.S. fund since 1998. So July will be 22 years on the same fund, and so obviously I've been through quite a lot, two of the worst three bear markets in history. I would say, though, that if I look back from when I started in the early 90s, whether it was the 94 peso crisis or 97 Russian debt default or long-term capital 98, 2000, 2002, or 2008, the major catalyst for a large market break has typically been the Federal Reserve. A mistake by the Federal Reserve raising interest rates too much, whether that was in emerging markets in 94 or housing began to roll over in 05 and they kept raising interest rates. I'd say in this case, the Federal Reserve is off the table in 2020. They told us in 2018 they were going to raise rates 4 times, they cut them 3 times. They told us that they were going to run off the balance sheet, and they added $500 billion to the balance sheet. So with them not raising interest rates and not running off the balance sheet, I think that they've moved off to the sidelines. And so that risk, which is, for me, one of the bigger risks, has kind of moved to the sidelines. Having said that, though, the market went up a lot last year, and earnings went down, which means you've had a large expansion in valuations. And so the question becomes, this large move in valuations, which companies are justified in having those superior valuations, and which companies are really just too expensive? So I think 2020 is looking like a year where I think the returns are going to be good, but I think they're going to become much more stock specific. I don't think it's just a general market as a whole. I think some of these companies really need to prove that they warrant or they're worthy of these valuations, and we really need to see the earnings come through. Now, in the last few days, the earnings have been very strong. Amazon tonight reported very strong earnings. Microsoft reported strong earnings. So we're seeing strong earnings come through, but I think that's what's going to keep the market going. We can't just sort of rely on expanding multiples like we had in 2019.
And so my approach to the market is a lot from an asset allocation perspective. So I've got a very top-down macro look at the market your style is more bottoms up. You look
Right.
at companies. You're concerned about interest rates, but you look at companies.
Right.
And technology stocks have definitely been a fuel to help the market move forward. Is there still room for technology stocks to go higher?
Yeah, I think in the technology space, we're still in the very early stages of what we would call the digital transformation and this move toward cloud computing. And so back in 2005, 2006, you had a company come public called Salesforce.com. It's an unfortunate name after the .com issues of the late 1990s. But Salesforce.com did customer relationship management software. But it was all cloud-based, so it was a subscription, and then you would use Salesforce.com. A lot of companies were using different systems like Siebel or Jana, or different systems for customer interaction. When their salespeople would call or their inside salespeople, they would use a system like that. So the early days were basically, let's move to the cloud, let's put our app online. And that was very strong growth. And a lot of people said, well, the market's limited and people don't want their customer information in the cloud. But what we really began to see was, probably the landmark deal for cloud companies, I think it was sometime in 2007. State Farm, which I'm sure you all know, a very large company, signed a deal with Salesforce.com for well over $100 million, which was at the time one of the largest deals for cloud computing that we've ever seen. And if you asked what State Farm was using before, it would be shocking. They weren't using a CRM system. They weren't using a customer relationship management software system. They were using Excel spreadsheets. So if you think of a firm the size of State Farm that was having all their customer, this may be why you can't get anybody on the phone when you call your insurance company. I don't know how they think. Rogers might be doing the same thing. I don't know. Anyway, but they were using that. So this wasn't like, oh, what's the addressable market and how big could the company be? This idea that all the technology resides at another company and I just have to subscribe got them to move towards the cloud. Now we're at a point in time where companies are now beginning to say, and you saw this tonight in Amazon has a business called Amazon Web Services, where companies rent cloud space. They use their computer infrastructure instead of their own. Microsoft has that with Azure. Both companies reported very strong numbers. But we've reached such a size and scale that what we're beginning to see are companies now viewing technology as a revenue generator. So if you talk to anybody at the Bank of Nova Scotia, for 40 years, they would say computers are a cost. It's something we spend money on for processes, for compliance, for whatever. But now, what companies have seen is the success of Google and Facebook. And so, for example, let's say, for example, I decide to buy a bathing suit tomorrow. I apologize, you've all eaten, so...
a little early in the season, Noah.
But what should happen when I buy that bathing suit? Well, what should happen is if I use my Scotia Visa, I should immediately get an email from Scotia offering me a travel rewards visa. Because clearly if I bought a bathing suit in January, there's a small probability I'm crazy, but there's a much greater probability I'm going somewhere. And then the second email should come from Scotia Insurance, where they're offering me travel insurance because, out-of-country healthcare costs. Now, that's something Google and Facebook will do. That's something that they've learned how to mine your data. But it's something that these larger companies haven't learned how to do yet. And so they're just beginning that. So $1.7 trillion is spent a year on technology, and only $160 billion of that is on the cloud. So I think a lot more is going that way. But it's going to become a tougher market for maybe some of the older technology companies, perhaps an Oracle or an IBM. But some of the companies that are helping this move towards the cloud and are helping bring machine learning and artificial intelligence, and now beginning to say, I just met a company in New York last week, and they have software for call centers, call centers aren't a great business if you think about it. But imagine if you had thousands of calls coming into your office every day, and what they're basically going to be able to do is takes all those voice calls and translate them into text. Now, I know you hear often, this call is monitored for quality assurance. It's not. And now, no one's going to read the transcripts either, right? But let's say, for example, in your case, let's say, all the calls came in from clients, and now you said, you know what, I'm thinking about having an evening on perhaps wills and estates. I'd like to do just an information session. I'd like to search every client that's called and had a conversation in our office on Wilson Estates over the past 2 years. And because you have that all in text, and now it's like a Google search on top of that, because the system resides in the Google Cloud, you can pull up everybody that's called in. So instead of having 100 people there or sending out 500 emails, you may now have a group of only 30 people, but 30 people who actually care, right? And so that ability to mine the data and manage the data, those practical implications, that's just sort of beginning right now. I think Google and Facebook have shown people how you can use data to make better sales, and I think that process is just starting. I think it's got a long way to go.
Well, that's why we have you here. You really know your stuff in that sector. Is it outside of technology? Do you see things that are interesting, or are you focused primarily on technology?
No, I'm focused on anything that's growing, and for most part, that's been in the technology space. But technology is very different than it was when I started in the '90s. You know, in the '90s, it was all about a personal computer on your desktop, and then it was the Intel chips inside, or the Micron memory, or the Western Digital hard drive, or maybe it was the 3-comma Cisco networking computer. Everything was tied towards that PC. Now technology is a platform. So if you're a Lululemon or you're a retailer, you have to have an online strategy. You know, if someone comes into the store, they don't have it, the person that's helping you needs to be able to order it online immediately, right? You always have to have this digital strategy. If you're a media company, even now Disney and NBC have gone into standalone apps to compete with Netflix. And so technology is no longer a product or a piece of hardware. It's sort of a platform in terms of how people access media, access travel, access a whole bunch of things. So I would say that we look for areas that are growing, and that's certainly growing. I would say last year, one of our bigger successes has been in the healthcare space. Despite Bernie Sanders and Elizabeth Warren specifically hurting the healthcare sector in the US last year, you know, a few companies we've owned were acquired. That's pretty substantial premiums. And what I would say is that we're seeing in the US, we're seeing two things that are fairly exciting to me. You know, it's interesting with, I remember very clearly where I was when Magic Johnson announced that he was HIV positive. I was at University of Toronto, I was still a young kid. And I remember, you know, if you grew up in the 1980s, it was like, well, that's just terrible. I mean, how long? He's got a few years to live. And we did an event in Santa Barbara in 2015, and the guest speaker was Magic Johnson. And Magic Johnson, you know, you can see him on TV and all these tributes to Kobe Bryant after that tragedy. So why is Magic Johnson still alive? And that's really because in the mid-1990s, they came up with this cocktail of HIV drugs, where they combined 3 different drug therapies. And so you're never actually cured of HIV, but you held the virus in check to almost undetectable levels. And so a man born today who stays relatively healthy and takes his medication has almost the same life expectancy as a man who doesn't have HIV, which is pretty incredible. HIV is now treated almost like diabetes versus what it was in the 1980s or 90s. That concept of using multiple drugs is really beginning to take off in oncology. And so where you can combine different drugs together to say, you know, we all hope and pray for a cure to cancer. It's one of the most horrible, and I'm sure everyone in this room has been touched by it, including myself. But where you can combine drug therapies to say, you know, if we use 2 of these drugs or 3 of these drugs in combination, is there a way to, you know, maybe we can't treat it, but maybe we can hold it at a stage 1A or a stage 2A. Maybe life expectancy could go from 3 years to 7 years or to 10 years. And there's amazing data coming out. And I think that's why there was so much M&A, especially in oncology. It's all about the combination of these drugs. The longer term opportunity is this technology you may have heard of or may not have heard of called CRISPR and Cas9, is where there's a couple of different ways to do it, but it's repairing genetic defects or the ability to take the DNA of the tumor out, put it into a weakened flu virus, have your immune system identify it, and then the biggest problem with cancer is your body doesn't know it's there, and have it identify and attack it. That's much further along. That's more of a 10-year story than a today's story. But combination therapy in oncology, in terms of the results we've been seeing at the American Society of Clinical Oncology and stuff like that, there's some very, very exciting stuff. And so, you know, we had Loxo Oncology acquired for a 65% premium. We had Array Biopharma acquired by Pfizer for a 65% premium. So there's major work going on in combination therapy. It worked in HIV. It's actually working in cystic fibrosis. It's a company called Vertex Pharmaceuticals, which has now come out with the triple. The first cystic fibrosis drug was okay. The second cystic fibrosis drug, used in combination, was better. The triple combination has had dramatic impact on the lives of cystic fibrosis patients. So we're seeing combination therapies really beginning to become the standard of care. And obviously in oncology, that's a big opportunity.
So when you're dealing with companies, clearly you seem to be that are in a growth mode, that are growing, then they tend to trade at higher multiples than the market.
Sure.
Which would make me wonder or think that they're likely going to come down more than the market when the market goes the other way. What do you do as an investor if you've got new money? Can you be comfortable investing in a fund that's investing in those kind of growth companies?
I mean, everybody's a 10-year investor, but it's pretty much 1 month at a time.
Yes.
And I've been doing this for a long period of time, and I've gone through some big market breaks. And I would say, the lessons of 2000 and 2002 and 2008, even when those market breaks came, our fund went to new highs long before the market went to new highs. Mm-hmm. And whether that was finding, in 2002, whether it was a Genentech or Whole Foods Markets or eBay or coming out of 2008, I think in October of 2008, Apple traded to the price Apple traded at in 2008 was equal to what they earned 2 years later. So they basically traded at 1 times earnings. So we do a lot of work on valuation, trying to figure out how much bigger the company can be and how much faster it can grow. But really, we're trying to find, when Google came public, it was doing $1.8 billion of revenues. And the estimates were for $3.45. And our question was, $600 billion a year spent on advertising globally, less than 2% of that goes online. If 10% goes online, it's a $60 billion market. And half of that search, could Google do somewhere between 10 and 20 billion of revenue? The answer was yeah. And what would they earn on that? And it was anywhere between sort of $25 and $35 a share. That's a far cry from $3.75.
Yeah.
But 5 years later, that's about what they earned. Facebook, when they went public in 2012, 6 months later, stock got cut in half.
Yes.
After the IPO.
Remember that.
And it was like, if you did the same sort of work on Google on Facebook at $21, you came up with sort of $7 to $9 a share of earnings power 5 years out. Well, if you think about it, Facebook went from 21 to 220. And that earnings power is about $10 a share now. So I didn't know if the market would pay 10 times earnings for Facebook. But if they did pay 10 times earnings for Facebook and it was a $7 number, it was a $70 stock. If they paid 20 times, it's 140, or if the upside scenario was 180. So there was a substantial amount of upside if they could sort of replicate what Google had done 7 years earlier in terms of capturing market share. And obviously, they went well beyond that in terms of both those companies. So our valuation work is not, anybody can look up a P/E ratio on Yahoo Finance. You don't need me to do that for you. What we're trying to figure out more is 5 years from now, where can this company be? When I bought Apple, I bought it at 38 times earnings. And 3 analysts covered it. And when I sold it, the entire world covered it, and it was trading at 11 times earnings. And I know that's the opposite of what most people think. And that's because the earnings went up so much more than the stock price. So we look at valuation in that context, that a company is worth what its future earnings are, and we're comfortable with the companies we own. I think the problem becomes if you own a company that's not growing and you're paying a high multiple, the problem becomes you've really overpaid for that asset. And so that's sort of the market we're in a bit today. You really need to do the work on individual companies to make sure you're comfortable with the growth and the valuation relative to that growth, because a lot of stuff went up that last year. And I think it's going to be trees and forests in 2020 for sure.
So when we were talking about how it's time in the market, not timing, when the market really goes down, you're going to be getting some great deals on some really high growth companies to set you up well for when it goes the other way.
Right. And so, I think one of the more interesting things that I've seen, I'm now, in April I'll turn 50. And I know what you're all thinking, that's impossible. And
You're very young for 50, Noah.
Well, remember, I started running money at 24. So for about 10 years, I told everybody I was around 30, because nobody would talk to me when I was in my 20s and running money. And my photo was terrible. I looked like a bar mitzvah photo on my. So it was very hard for people to take me seriously when I was in my 20s running funds. But anyway, here I am at 50, and I look the same. I'm of the vintage now where my first daughter is now off to university. It's her first year of university. She broke my heart and went to Queen's instead of the University of Toronto, but that's okay. That's what daughters do to their fathers. But there's a lot of advisors and people I know who are sort of around my age and have their children going off to university. And these are people who in the RESP programs, maximize it with just put 100% Power American or Power Global, one of the funds I run, and they never really looked at it. And I've had quite a few people in the last year come up to me and basically say, you've paid for my kids' entire education. Like, I don't have to worry about where I sent them. So whether it was McGill or Western or Simon Fraser or UBC or Toronto, that sort of makes it real. And so for the people who have been able to, buy and not worry about it and know the longer term growth skates us on side and the trajectory longer term of the markets is up, they've been able to do extremely well. For the more conservative investor, we have funds like Alpha Performance, which are obviously much more conservative, use the short side of the portfolio to manage volatility. That's for a much older client who's just looking for that mid-single digit return with low volatility. But for the 40 and 50-year-old who has a lot of years, or for the RESP client who have 20 years ahead of them, it drives me. I saw a portfolio once of a 30-year-old in the Globe and Mail. They used to do this thing. This person's 30 years old, and they had all of these bonds and preferred shares. I'm like, you're 30 years old. You have 45 years of investing. Put the pedal to the floor. The time is your friend, and it'll work for you. So I think asset allocation is time dependent. That's why we rely on people like you to know your client, to do the right allocation. But I do think that there are some secular opportunities out there for sure, longer term. And we've done very well over the last. We started in 1998. If you pick up the Globe and Mail, they'd probably say I didn't exist, but we've more than doubled the S&P 500 return over the last 21 years after fees. And that's only by sticking to our discipline and process. In terms of what we do, we don't pay attention to the index or anything like that. The portfolio looks much different than the overall index, and we just sort of focus specifically on what we do.
Okay, well, in the interest of time, I just want to say that your daughter's staying in Canada, so actually you're pretty lucky. My daughter went to Scotland, so my university was paid in British pounds. So I really could have used that additional growth to finance that.
I'm fairly certain you could have. I was around, but you can't use an RESP in Scotland, is that right?
Yeah.
You could?
No, you definitely can use the RESP out of the country. Yeah, as long as it's a credit.
At least the British pounds collapsed.
So it didn't collapse when she was there for me, unfortunately. So one more quick question. Already said interest rates.
Yes.
Something to watch. Anything else that people should be watching for when they're thinking about 2020?
I think, I realize coming to this event that you're hosting, I'm supposed to flatter you.
And you haven't been doing a great job so far, no.
I understand that, but what I would say is that your role is extremely important right now. And especially given where bonds are, I think asset allocation is going to take a much more unique strategy in terms of how you position portfolios, how you find assets that can work within those portfolios. So I really do believe that it's going to be an interesting market in terms of bonds aren't returning what they used to return, and how you structure portfolios and stuff like that. I mean, I do what I do, and how that fits with you and your clients. That's one thing. But I do believe that you really need it's a worthwhile conversation to sit down with you in 2020 and 2021, making sure the asset allocation is right and that you've structured portfolios properly. Because I think now is the most important time to make sure that you're positioned properly in terms of whether it's corporates or governments or high-yielding equities or alternatives or whatever it is. That it's really important to make sure that you're structured properly. You might have said that or not, I don't know.
Well, last year we talked about alternative investments as a way of actually protecting the portfolio a little bit without getting so conservative as bonds or GICs. Thanks for your time, Noah. Andy, outlook for 2020. What are the things? What are the opportunities, and what should we be watching to be careful of?
The way that we've characterized 2020 and even the next couple of years is that we are close to the end of the business cycle. And it's not necessarily that it's an ominous end, it's just that the business cycle continues to mature, which translates into growth that is more difficult to come by. So in that context, we want to make sure that we are prepared for any mean reversion as it pertains to an increase in volatility, the portfolios are properly positioned, and that they are well asset allocated, which is a comment that Noah made. And that's really the most important thing. You know, generally when most people think of asset allocation, they bifurcate it into two major categories. There's equities and fixed income, and those asset classes can perform very differently. Equities being tethered to corporate profitability, so anytime we get concerned about the visibility of corporate earnings growth or the likelihood that it's going to materialize, we see equities bounce up and down. With fixed income investments, you know, where if you own fixed income securities, you're lending money to somebody, so they tend to be much more predictable and stable asset classes. It's the combination of equities, fixed income, commingled with things like alternative investments, which have a relatively low correlation to the other two asset classes, that can help protect capital and ultimately allow us to make tactical asset allocation decisions that compound at a much higher rate going forward. So as we look to 2020, I think that increase in volatility could present us with very good opportunities to make those tactical allocation decisions, especially considering how buoyant the market has been, seemingly shrugging off a lot of geopolitical risks and concerns that could potentially become a little bit more amplified as time goes on.
Thanks, Andy. Any thoughts about interest rates and whether you feel that interest rates are likely, the Federal Reserve will maybe change stance and rates will go higher? What do you think the probability is of that?
Yeah, so it's a great question, Darren. You know, it's important to distinguish between short-term and long-term interest rates. So generally, when central banks move interest rates up and down, what they're doing is, in fact, affecting a change in short-term interest rates. And that doesn't really change the output potential of an economy. And when we say that, that's how much the economy could produce if it utilized all its available resources. When they move short-term interest rates, they're really pulling growth forward or pushing it back. Importantly, what we care about as investors, long-term interest rates, because that's what we use to ascribe value to assets. If you buy commercial real estate, you're discounting cash flows from a building. You're doing that using long-term interest rates. The price of a bond is the equivalent of the discounted value of all the interest payments you're going to get. And it's the same thing with equities, except we use PE multiples as a pretty lazy way to discount fair value. But long-term interest rates matter a lot. And when we take that longer-term view of the global economy, there are no question that there are some constraints that are going to affect global economic growth, inflation, and interest rates. And they happen to be the excess indebtedness that is really encumbered governments, households, and corporations in a lot of different parts of the world. Public and private market debt to GDP has never been higher. That's problematic because if you think interest rates can go up and stay up, we have to be able to not just service our debt obligations, but repay them. So that's a very significant constraint. In addition to that, we have a demographic constraint that affects the output potential of economies. I talked about that being comprised of the ability to use all the resources within the economy. That means people and the goods and services those people produce. And as the global population ages, and it's going to age quite significantly with the number of people over the age of 65 projected to double over the course of the next few decades, that means that labor force growth is going to remain constrained, which limits our ability to grow our way out of the excess indebtedness that I discussed. So generally, when we look forward, we think that there are several factors that are going to, think of them as a speed limit, be a speed limit when it comes to economic growth, inflation, and rates, which means that they likely head lower, notwithstanding the fact that central banks may want to increase interest rates at some point if it looks like the economy is heating up and we have inflationary problems that we need to deal with.
Good. Thanks, Andy. Okay, thank you, everybody. Come on out and have some refreshments and coffee.